running somewhere these days. We've gone from modest growth to a sudden correction in the stock market, largely thanks to a couple of factors. We hear a lot about China and a lot about the price of oil. Good morning, Dr. Bernard Weinstein of SMU's McGuire Energy Institute. And you say a lot of it is the oil. I filled up the other day for $1.57 a gallon. Why is that bad news?
Well, that's good for you, but it's not necessarily good for the economy. Remember that the oil industry employs directly and indirectly maybe 7-8 million people in the United States, and there are 33 states that produce commercial amounts of oil or natural gas. So when you see a 60-70% drop in price, that has ripple effects across the economy. The industry has laid off 250,000 people just in the last 18 months, and that's likely to continue. Every day you pick up the paper, BP's laying off 4,000 people, Shell's laying off people, Baker Hughes is laying off people. So that's not good for the U.S., and it's certainly not good for Texas.
On the flip side, though, I have more money to spend in other places other than at the gas pump. And doesn't that create jobs?
That's been the traditional argument. Everybody has more disposable income, they're going to go out and spend it. But they're not. They're not spending a lot of it. They're saving. They're reducing their debt. So while that's good for the long term, that's not good for the short term. But as you indicated, there are other factors as well that are affecting both the oil market and the stock market. And the slowdown in China is one of them.
Now, China is interesting because they're not in a recession. They're simply not growing as fast. If our economy was growing as fast as the slowdown in China, we'd be popping champagne corks. They're looking at what, maybe 5-6% growth?
Hard to tell because Chinese statistics are always suspicious. But when you go from 10 to 11% growth to a 5 to 6% growth, that's a significant slowdown. And remember, China has been absorbing about 50% of the world's commodities during this huge growth spurt. But it's not just the slowdown in China, it's some real questions about the viability of the Chinese economy and their financial institutions. And they're having an incredible real estate bubble, and their stock market has dropped about 15% just in the last 2 weeks. Our market's down about 10%. And I don't know what's going to happen today. Markets are down in Europe. That indicates that we'll probably see another drop here in the United States. So my advice, if anybody should ask me, is to stay calm. Because we're in a world of instant communication and we see volatility in the stock market, unlike what we saw in the past.
So if most of us don't directly buy and sell stocks every day, we're not sitting there, we might occasionally, once a month, once a quarter, once a year, check in on our retirement accounts.
Well, yeah, but you may not own stocks directly, but if you have an IRA or a 403B or a pension fund, you are invested in the stock market. So it is going to affect you. But individually, there's not much we can do about it except kind of ride out the storm. Remember what happened during the bust 7 or 8 years ago. The market dropped 40%. A lot of people bailed. That turned out to be an unwise thing to do because the market did come back. So I'm not in the business of offering an investment advice, but there's a lot of uncertainty in the markets, uncertainty about the global economy, some talk about recession, and all that is making the financial markets jittery.
And your advice, though, take a deep breath and remain calm. Thanks.
Just remember, if it can't go on forever, it won't.
Okay. Write that one down. More to come here on Good Day. Thanks so much, as always. It's an